Hello, traders. Welcome to our second live event. This is a momentous day because we have the FOMC statement coming up in about 2 hours or so. So we're going to do some market analysis. We're going to take a look at some picks. Harry has joined me. He's going dark right now.
Hey, everyone.
And so we'll answer some of the questions that you put up to us and kind of prepare you for what's to come with the FOMC statement. And we're not completely decided on whether or not we're going to do a post FOMC live event today or not for maybe the last hour of trading. We'll see. We'll see how this one goes. But in any event, Harry, say hi to everybody.
Hi, everybody. I hope you are all having a spectacular day because, you know, we are. All right. What do you think, Pete? What do you think on the FOMC here? I don't think the actual announcement's going to do much. I can't imagine anyone's expecting anything other than no rate increase. But to me, it comes down to the presser and how hawkish old Blue Eyes is going to be, because this market is pricing in my eyes, an insane number of rate cuts for 2024. And we all know how Powell feels about rate cuts. So he could come in and decide to throw a lot of cold water on that and say, I'm not even going to talk about rate cuts here, and neither should you. Or he could temper his language and make it seem like if the data supports it, we might consider pulling back on rates, in which case the market will take off with that. So what do you think?
Well, I think that they have been just as dovish as can imagine, hawkish as can imagine for the last year and a half, 2 years. They've stated publicly that they got inflation wrong. They will not make that mistake again. And there have been periods where I felt that they could have been more dovish than they were, like a year ago, last year, when we were in a bear market. And nope. They stood the course and said, we're going to keep hiking rates. We don't care what the market feels about it. This is our path. And so I think that I'm kind of in the camp to where they'll say, yeah, you know, we've raised aggressively over the course of the last year, biggest rate hikes that we've seen ever. It was warranted. And now we're still waiting to see what the aftermath is and what the economic repercussions are going to be. But everything seems to be on solid footing. And so, yeah, we're going to pause because we think that's prudent. But for those of you who are looking for a rate cut in Q1, forget about it. That's what I think they're going to say.
I mean, look. Credit to where credit's due. They fucked up in the beginning. Obviously, it's transient inflation. Yeah, not really. So they messed up. But to their credit, as you said, literally, I mean, the most aggressive rate hike since Volcker, and one could say, given the contained time frame, even more aggressive than he was. And look at the market. We are at a high of the year. We're only a point or two off of percentage point or two off the all-time high. The unemployment has stayed low. I mean, they have managed to thread a very fine needle and stop where, they well above, because people were screaming when they were at 4%, no more, and then 4.5%, no more. Well, they brought it right to the edge. It does not look like that there's a recession in store yet. One never knows. Anything could happen, credit crunch, etc. But if they could manage to thread this needle, I think historically, it's going to change a lot of economic calculations about the effects of rate hikes on things like unemployment and the economy. But two, I think Powell will go down as someone who corrected an obvious mistake and did so in almost impossible fashion.
Yeah, it has been pretty incredible. When you said earlier that they've been able to manage or thread the needle, that was a little suspicious back in March when we had a couple of bank failures. It was like, uh-oh.
Yep.
Is this the warning sign? And having been through a financial crisis, my guard was up. And based on the price action alone, back in March, which why don't I put that longer term chart up? I was just starting to get to the point to where I like what I saw in the market, because we'd started off the year, we had this big low here, rallied up, we had this nice higher low double bottom. Talk about a massive bullish engulfing candle. So yeah, that set the low. And so we had been grinding higher and everything in pretty decent shape. And then this is about where we started to get into some of the credit concerns in here. And I started to think, better to be safe than sorry. Been through this before. We better wait a couple of months before we start swinging from the long side. And so lo and behold, this low and those bank failures, the market actually bought that, which I was a little bit surprised. And so by this point in here, I'm like, yeah, look at that nice rally that unfolds. Now I'm getting dang bullish because there aren't any more credit issues. So that's kind of how the year unfolded for me.
Go figure that a lot of those bank failures were due to gross incompetence. I mean, shocker that people who run banks were incompetent. But as is often seen, a lot of these problems, I mean, sure, rate hikes don't help, but they could have secured themselves against that. And I think that's what the market saw, which was this was not a systemic problem. This was a moronic problem. And once you fix the idiocy, then we should stabilize. And that's pretty much what happened. You know, it was just a matter of well, greed on the part of those who run regional banks, and not to insure themselves against what was obviously going to be a longer protracted fight against inflation. So I think another issue that might start bugging into the Fed's ear as we progress is their absolute determination on this 2% number. And, you know, they're asked, all right, if it's 2.2%, will you stop? And no. 2.5, will you stop? No. It has to be 2%. And, you know, I think at some point, you know, if it's at the end of 2024 and we're at 2 point whatever, 3%, and he's asked, mission accomplished or no, and he says, no, we're not going to stop till we're at 2, we might start getting some blowback on that. But either way, I think there's probably, dare I say, a little bit more downside today off the FOMC. Because the pricing in 4 rate hikes, there's very little that Powell can do to reassure that. How is he going to go out and reassure? Yeah, you guys are right. 4 rate hikes next year is gonna be the deal. They're going to parse every single word he says, and I'm sure find something in there to say, well, maybe he won't do it. So, but we will see. As you said, we can only trade what the market's going to show us, right? And as I mentioned in the chat room earlier, for anyone listening, you just need to ask yourself right now, look at your positions that you have. Obviously, most of the time in this situation, the best position is cash going into a statement or a major market mover like this. But let's say you're not in cash and you have positions. Ask yourself, if he comes out and he's very hawkish and all of a sudden, let's say SPY closes today at 459. Let's just throw 459 closes today because he's hawkish and bam, drop. Are you prepared for that? I'm not saying it's going to happen. I'm saying it could happen. It could also go to 469, right? But in which case you're going to be very happy because most of you are long. But if it goes to 459, are you prepared to that? Are you prepared to shoulder that? Are you prepared to say, oh, okay, it'll bounce back tomorrow. I'm going to hold my positions. Do you know where you're going to cut your losses? You need to have that game plan, because if you're not in cash, that is a realistic eventuality that could occur today.
Yeah, I agree with that. And so let's talk a little bit about light volume rallies. Volume has been this mysterious concept, and we hear it time in and time out that, oh, a light volume rally is bearish. It is absolutely not bearish. So how do I gauge volume and where does it come into play? Price action is everything, okay? Everything depends on what price is telling us. But we can have stronger conviction when there's some volume behind it. So when we see a light volume rally, it just means that instead of going gonzo, we're mildly bullish and we trade that move higher. It doesn't mean that the market is going to roll over. If the market rally starts to stall out, compressed candles, start to see some red candles, especially some long ones, okay, then you know that there's a chance that the gains could be given up. But a lot of light volume rallies, like we saw earlier in the year, start to gain momentum and they start to gain volume. And you can see that happening right here this summer. So we had rallied up on fairly light volume, but then all of a sudden you start to see the volume come in on this liftoff and this breakout. And so that is legitimizing this move. This is legitimizing that breakout. And now you can actually start to get behind that move. And as the year unfolded in here, I'm thinking, boy, yeah, this is actually quite bullish, but we're coming into August, which is typically seasonal weakness. Got the Fed still saying that they're going to tighten. So a lot of those looming issues are still out there. We get this big pullback, but back here, I'm thinking we get the normal August through October pullback. I am very bullish into year end because of this. And because of the way that we came down and bounce and bounce and bounce. So this tells you that buyers are in there. So to Harry's point, right now you get a lot of buying in here. Big move up. These air pockets asset managers have missed because they happened on no volume. From here to here, there's no volume. Okay, so they didn't take advantage of that. Here to here, there's no volume. The index has moved. So the benchmark has moved, but they're not getting any trades off. So everybody's waiting for that dip that never comes. And then you start getting this nice gradual drift higher, which is exactly what we've been trading. It's what we've been highlighting for the last 6 weeks. In here, as you start taking those longer term swing trades and going, yeah, this looks really great. We're breaking out to a new high of the year. This is where you can have the mindset of, I'm a swing trader and I can weather these storms. FOMC, the market's going to explode higher. And so you start thinking in those terms, but you have to think about how much of a pullback am I willing to shoulder. So for those of you who think that you might be willing to shoulder a pullback, I mean, I think this is a pretty reasonable level, this compression here in this prior breakout level. This is where I'm expecting to see a pullback. Anything greater than that, I start to wonder, because I still feel asset managers are under allocated and that they're going to be scrambling to buy dips. So
yeah, I mean,
what's your sentiment?
We need to think about it in terms of, there's a difference in the burden of proof that a retail trader needs and with a institution needs. In terms of, institutions need a great deal of reassurance and we call obviously support, right? And so as a retail trader, you might say, oh, okay, we broke support, we bounced off support, I'm bullish, I'm going to go long on the stock. Whereas an institution is looking for mounting evidence that it is okay to start accumulating this stock. They're not looking at one day's price action. They're looking at that daily chart. They're looking at the weekly over time. And so obviously volume comes into that, right? You get these low volume pops on any given day. It doesn't mean much, but then you look at it over the course of a week, or you add it up. Now institutions start to get more bullish about a position because it's cumulative for them. And once they hit that sort of breaking point, that critical mass, then they come in and start buying. And that's where you start seeing your volume shoot up. That tells you, okay, we're convinced. Institutions saying, we're convinced that this stock is now safe for us to buy, and it's going to start going up. That's a very different standard than retail traders generally have. Retail traders are not a very patient bunch. But institutions, they'll wait it out. And if it's not, and if they miss it, they miss it. But they will wait it out to make sure they're highly confident that when they're accumulating into a position, that support, barring any drastic news break, is going to hold.
Yep, and that's what we're seeing right now is that volume increase. Back in here, I'd been mentioning that these guys are looking for a dip that's not coming. As we get closer to the high of the year, you are going to see that volume come in because now they get into panic mode that they never got the dip and they're under allocated. So they're bidding, 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 bidding. You only get a couple little red candles in here and then instantly right back at it every day. There's 1, 2, 3 red days that we've had in the last 6 weeks. So, and instantly gobbled up. So my suspicion is based on all of this, I think we could get a pullback because I think the Fed's going to splash some cold water, but I also think asset managers are going to be ready to gobble that up. You get a breakout test and then whoosh, higher into year end. That's what I'm looking for. Doesn't mean we're going to get that, but those are my expectations. I promised that we're going to do a little bit more Q&A, and I've got my YouTube channel up. So if you would, please post some questions in the chat section of the YouTube channel. I know, Harry, you watch yours also, so maybe we can field a few questions.
Yeah, absolutely. I want to quickly point out a stock because I'm sure that's what a lot of people are looking for. Though, again, keep in mind, FOMC is coming up, but I like PAN-W here, Palo Alto. I like its break first of the of a upward sloping trend line that starts on July 12th, and it broke out of compression yesterday, and then today it has just continued up in a fairly decent orderly fashion, never really breaking below VWAP today, testing it a few times, and then just taking off here. Has some great relative strength to the market, relative strength to its sector, and earnings you don't have to worry about. They're not until February. So I like PAN-W here, and if we have a bullish response on the market, I definitely would be looking at that stock to take off.
So Harry, as you mentioned a stock symbol, I'm going to bring up the chart so everyone can follow along. And yes, PANW looks great. You've got this little bullish flag formation, and then there's the breakout that Harry had just referenced. Go into a 15-minute chart. You can see how the stock has continued to march higher. What has the market done? Down, down, down in the last hour and a half. Stock up, up, up. I like it. I'm going to look at a couple questions here, but I always like to review picks that we've done in previous videos. So in my video Sunday, AVGO, that was my long of the video, and that stock has done nothing but scream higher. There's the 15-minute
Wow, you think that did well?
Beautiful. Yeah, that absolutely took off. The other stock that I had highlighted was DHI, and that is a home builder. And so DHI continues to also power higher. I like this on a longer term basis, and I suggested buying in the money calls, longer dated on this one with a high delta. So that's working out very well. AVGO, we're looking to sell an out of the money bullish put spread on that, give ourselves some distance. So no, I was not gonzo bullish. Like you got to go in there and buy a bunch of calls because they traded a fairly high implied volatility. So ADM was the other one that I had highlighted in my video Friday, and excuse me, AMD. And that has also done really well. So we're on the right stocks here, folks.
Yeah. I also like McDonald's today.
McDonald's I've seen coming up on all the searches. Let's see here. I've got Green Royal Flush. There's McDonald's right there. You can see the green dots across the board here. Everything looking good. Look at that little compression breakout. So I'm going to save a couple of the picks that I posted in the chat room today for a few more minutes. Do you have any questions that you want to put out there, Harry, that you want to answer?
Let's see. Kira just asked, curious how you think through the scenarios you put forward on post FOMC market outcomes with respect to your own positions. I'm a hedge trader, as people probably noticed. So what I do, I'm not the type of trader that goes to cash, but that doesn't mean it's not a good thing to do. I don't always do the best thing, obviously, Moderna, but I do tend to hedge, and so if I find that I have long positions that I like, for example, let's say I'm long PNW right now or long McDonald's right now, and FOMC is coming, and I don't want to close those positions, and I also think that the relative strength to weather a storm, I'll hedge. I'll find a few relatively weak stocks. I'll buy some in the money puts on those. I might even short SPY as a hedge, and I'll do it proportionally. I won't do a 50-50 hedge if my market thesis is overall long. Then I'm going to hedge, but I'm not going to do equal sides. I'm going to put a 10-20% hedge on, let's say, SPY or on a relatively weak stock, and particularly if you want to hedge on the FOMC, for example, what do higher for longer rates hurt the most? Tech. That it hurts the tech industry the most. So if you want to hedge against a bearish response to Powell, you'd find a relatively weak tech stock. You put a short on that if you have enough long positions. That's what I do. But again, that's very different than what you should do, which is if you are a beginner trader, intermediate trader, or non-profitable trader, any one of those, or they're all kind of redundant almost, then go to cash. What do you do?
For me personally, I tend to avoid binary events on a short-term basis, meaning all my day trades, short-term trades, I'm on the sidelines. I'll have some longer-term trades on. Every one of these meetings is different. Are we talking about the FOMC meeting right here? Are we talking about the FOMC meeting right here? Are we talking about it right here? You have to go with what the chart is telling you and with what the macro backdrop is telling you. So my response would be different in each one of those scenarios. Right now, I am bullish. And so I am longer term swing trades. Some of those are bullish put spreads, which those are to the point now to where you're buying them back for pennies. Yes, I would buy them back for pennies. Might as well release the margin. If you can buy it back for a penny or 2 cents, you've realized your maximum profit on the position. You don't need the margin. You can leave them on, but why take the risk? Just clean the slate and see if you get a pullback, and you can add some more to those positions. I am expecting a pullback in here. It may only last a day or 2 or 3, but yeah, I'm expecting a pullback to this level. So I'm completely prepared for it on a swing basis. Based on what the pullback looks like, that pullback may prompt me to add to my longer term swing positions if that breakout holds and we continue to move higher, as I believe we will. So if the move down becomes more sustained and you start having some long red candles in here, then what do? Do you panic on that first drop down below what you thought was going to happen? No.
Got another question.
Longer term swing trade. The reason for it is because if you have a move like this move is going to die very, very hard. You may have some overextended bullish speculators who get flushed out initially, but you will almost always try and challenge that high. And when you try and rally up and you were wrong, this lower high double top, that is where you exit if you were wrong. But you were going to get that type of test of the high if the market is ultimately going to pull back. So you don't have to panic right in here on longer term swing trades. You can wait until you get that retest. We had a similar retest here. Long swing trades. I'm all long. Oh, this is great. Blam. Do I have to panic in here if I'm long something for 3 or 4 months? Wait for that bounce. You know you're going to get it after strength like that. So that's what you have. That's how I would approach it. I did have a couple questions regarding, gee, should you put on a bullish put spread right now based on the FOMC statement, because we're likely to have some nervous jitters and those bullish put spreads will be farther out of the money so we can weather that storm. My answer would be no, I would not be putting them on right now ahead of a big event like that, because you have the potential for a big market move. And so, no, I'm not looking to enter those until I get a pullback of some type or confirmation that we are going to start moving higher.
Got a question here from Phil. I know this is a big one. Even in the wiki, it is mentioned as a big issue, but profit taking. A lot of question marks after that. Dynamic, not dynamic. I mean, I know the answer is personal. It's very personal, Phil. Just so I can't even talk about it. But I wouldn't mind hearing the answer to that from two different pros live. I already read the articles multiple times, but I feel like it's a good question in general that not only I have. Well, if we take a look at my screen here, Will, if you got me there, you'll see Tesla. And so this morning I shorted Tesla, right? And I shorted it right here, which is right at the 50 SMA. So now the question, well, why would you do that, right? Why would you short at the 50? Why would you short at the SMA and not wait for confirmation? Well, one, this is going to be, in my mind, a very short-term trade, because I have the FOMC coming. I don't want to hold this past it. So I want to know if it breaks through that moving average. I know where I'm going to get a huge sell event. I'm going to get these sell stops triggered. I'm going to get a big red bar there. I also know that if it doesn't, if it stays above, I have not only that SMA, I have VWAP right above it, about $1 above it, that if I see confirmation that the stock is staying above VWAP and above the SMA, I'm able to get out before the FOMC and take $1 loss, right? And I was prepared to do that when it broke VWAP, and I was waiting on that next candle. The next candle went right back below it. But if it had stayed up, if it confirmed above VWAP, I would have gotten out. But it didn't. It fell back below. It did break the SMA. It broke it with conviction, and then came that long red bar. So I put my price target in for $3, waited, and it triggered. So that was an example of, I had a plan going in on where I would take profit, where I would take a loss, how long I wanted to hold the trade. And it shows just how individual and how much context matters when it comes to profit taking. If, I'm in profit on NVIDIA right now, but I'm going to let that roll until Friday because NVIDIA is strong. It's broken through. It has support. But Tesla, on the other hand, Tesla also has a history of when it has these recall events, it takes a hit on one day and then it bounces back the next day. I also wasn't going to wait around for that. So I had, okay, if it breaks the SMA, I'm going to get a quick $2 to $3 off of this. If it doesn't, I'm going to take $1 loss. I like the risk reward on that, and it's a short-term trade. Other trades are going to be different, but that just shows that there's different mindsets for different trades. But more importantly, it's important to have a plan going into the trade.
I had a question on AVGO. Okay, you post this great trade, and I'm so nervous going into that trade on Monday when I'm watching the stock scream higher. How do you use alerts for that? How do you manage the trade? So, Will, if you could put my chart up, thank you much. There's AVGO, and you get this big, long green candle and stacked nice green candles. We want to see this on massive volume. The reason that I liked it so much was, look at this close on Friday. Look at that volume right in there. Just incredible. So the stock closes on its high. So this is a sign that institutions are in there. That's why I liked it. Now you get this follow through the next day, and you're nervous in here because you're taught not to chase. Don't chase, don't chase, don't chase. Wait for the market. Well, we also had a conducive market backdrop. Specifically, you're asking about alerts, and one alert that I like using, especially when I have a very, very strong, powerful move like this, and I am not expecting a big pullback of any kind. I need to pick the most sensitive variable that I can. And one of the more sensitive ones is HA and HA reversals. And so I'm not going to go through setting the alert, although it would only take me a couple of seconds. If I go into an HA chart, you can see that you get a flat red top in here and you get a flat green bottom candle right here. That is your HA reversal. That is when you get the alert. VWAP preserved. So VWAP would be your stop if you go back below it. But we didn't. Stock kept moving higher. Nice, tight, tight, tight patterns. I love this because it tells you that buyers just keep raising bids and you never have a chance for the stock to pull back. Yesterday, lo and behold, here goes AVGO again. I can't chase this. Okay. Pulls back to the VWAP. Flat top red, flat bottom green, VWAP preserved, good entry, tight stop. See you later.
I think everyone should give themselves the AVGO test, which is when you look at AVGO and you look at Monday, you see it shoot up. I'm willing to bet that at some point, more than half of you thought maybe this is a good time to put a short on. If you thought that, you are not ready to trade. You are not ready to trade your money. You're going to lose it. If at any point during that whole jump up on AVGO, you thought it's going to reverse, I should have a short on, and I'm sure some of you probably did, that is your test of one of the things that you should ask yourself if you're ready to actually trade money to make a profit. Because all you should be thinking is, I'm bullish on that stock until I'm shown otherwise. It has now broken its upward trend line that it bounced off of on Monday. Yesterday it broke it, and then today now continues up. If you had short that stock on Monday or Tuesday or even today, you'd be screwed right now. But the mindset is what you're testing. You're testing your mindset, because if your first thought looking at that chart isn't, this is still a good long, that's a mindset issue.
I have a question for retail traders that are struggling with mindset. If you aren't able to follow the wiki with one share or contract and you tend to oversize, how would you handle that? You have to trade one share or one contract. That's how you handle it. You cannot, the old earn while you learn phrase really doesn't apply to trading, because you could lose all of your money while you're learning and then you have nothing left. So if you can't find it in yourself to trade small and to keep your size small when you're learning, just don't even do it. Just don't even try, because you're going to blow your account out and you're going to be a statistic and you're going to go into the 90% who try fail category. So save yourself some money.
That idea of I'm not able to stop eating 10 Big Macs a day. So how can I lose weight? Well, you fucking can't. I mean, what do you want me to say? I mean, you don't have the self-control to trade one share until you are ready, until you see, damn, okay, I got it now. And you hit those milestones, then yeah, there's no pep talk in the world I can give you here that's going to tell you it's okay to figure out another way to trade decent size but still get your mindset under control, because you've just proven your mindset isn't under control, that you can't even do that for 3 months and trade one share and hit your milestones and then move on. Because guess what? If you trade for 3 months and don't hit your milestones, you would have lost a lot of money. It really is. I keep going back, but it's like chess or poker, where it doesn't take long to learn how to play. You know, unless you're a complete idiot, it shouldn't take that long to learn the basics of poker or chess. This is how the pieces move. This is the rank of the hands. This is betting and so on. It takes a long time to master it, and what you're mastering is the mindset part of it. You're not those rules that are in place take a mindset that is drastically different than the mindset you live with every day, and it's very, very difficult to overcome that. So, and part of that is not seeing this as a job, and that, I think, if you really wrap your head around, when you're practicing, it's like you're an intern, and you're getting ready to take the position full time. But if you fuck up as an intern, nobody's going to give you the position. So think of yourselves as interns trying to get the bigger job. Can't control myself, Jesus. Control my
Well, and that does dovetail into a question that was asked: what would I change if I had to do it all over again? And I'm a starting trader, and how would I do things differently? Yeah, one of them is I would have traded smaller size, and I had many years in the industry under my belt. So, and I had talked to so many professionals that I thought I had all the information and knowledge that I needed. I knew it was going to be tough. I knew this is a career change for me, but I also decided to go pro and to support my family on that income. And it didn't work out well for 8 months. I was in what I feel was one of the toughest trading environments. Although I think anyone that goes pro, that's probably going to be true no matter what market environment you're in. The first 8 months are going to be brutally difficult. So I was trading size, and I was losing money and leaking oil. And so that's one thing I would have done differently, is if I could learn a systematic trading approach with smaller size, it would have made things a lot easier on me. You all do have the advantage of having a systematic trading approach laid out before you. I didn't have that. I read a lot of books. I can't say that I learned a lot about trading from any book that I read. Yeah, I read how to read charts and stuff like that, but that's not how you learn how to trade. It really isn't. It's through experience and through trade logs and through managing your emotions and your position sizing and going through a variety of different market conditions and taking some of those lessons and really breaking them down and realizing where they played a critical role in how you were approaching the market. So yeah, going through and finding a decision-making process. You know what the starting point is and what the end point is. And it doesn't have to be the system that we trade, relative strength or relative weakness, but anyone worth their weight in salt is going to have defined steps that you have to take before you even enter the trade. And then before you enter the trade, you also know what your exit strategy is, be it your target or your stop. It doesn't have to be mechanical, but you have to have an idea of how you're going to adapt your current positions based on market conditions that you might feel are unlikely, but still possible.
Question here. Harry, do you have any guidance regarding sizing up the past the paper one share contract phase? Would you recommend going in 3-month periods? Sizing up every 3 months should be the standard metric met. Additionally, should we switch to purely assessing our trading via profit metrics or the standard 75% to profit factor? Okay, a couple of questions there. Well, one, I'll tell you, I mean, that guide is written based on how I did it, right? And once I passed those metrics, once I was confident that, okay, I have this, I went and just traded full size. But here's what I did. My account years ago starting $40,000, started with that. Every 6 months, if I hit my profit numbers, which is, you set that because that's your salary. If I'm able to continuously hit and my profit numbers, then at the end of 6 months, I increase my base by 15%, right? Now, I'm the type of trader that if I have 5 million in the account, I'm trading 5 million, or I'm trading 20 million. I'm trading the entire amount. I'm trading it right up to a margin call, and sometimes even beyond that, because fuck it. But I'm not the only 5% to this trader that you see my trades. I trade balls to the wall. But what I will do is I will increase 15% every 6 months on my account, as long as the preceding 6 months I hit my profit targets and I consistently hit those profits, those numbers. And yes, you do switch over to profit metrics after you have hit those benchmarks, the 75% win rate and the 2.0 profit factor. After that, all that matters is profit. If you go in and you say, okay, I need to make $1,000 a month, or 20,000 a month, or whatever a month, and you're hitting that target consistently, I don't give a shit what your win rate or profit factor is. As long as you are consistently hitting it using a repeatable method, you're doing fine. Those targets are meant to make sure you have mastered the foundational basics that you need to build off of in order to become consistently profitable. Because if you can't do that, then you can't make this a job. But you should go into it after you have hit those numbers and you're ready to trade and you're ready to, trade actual size. You should have a business plan, because it is a business. How much are you laying out in terms of membership fees to things, in terms of software, monitors, computers, everything else that you need that's going to cost you your hard cost of becoming a trader? And then what do you need to make each month for that to be worth it? What is your profit? How much are you going to be taking out of your account each month? What is your, everyone is different. Everyone has a different goal, but you need a business plan in place in order to do that. And if you start trading without that business plan, you're going to just be all over the map.
I'm going to shift gears a little bit and show you a stock that I like, and then we'll get back to some more Q&A. I like MDT. Why the heck do you like this thing? What is there possibly that you could see in this thing that looks good to you? Well, we had a longer term downward sloping trend line that was breached. Okay. We had the AVWAP-E. All right. Well, we're hugging that right now. You can see the big gap up that we had post earnings. The B shows the earnings were before the open. We have a double bottom, higher low, a couple of bullish hammers. Okay. Nothing in here right now is too compelling except for this nice move off of the low and this gradual drift higher. This is a compression. If I put up 1.0 squeeze, you're going to see the yellow dots are going to indicate that this is in a compression. See right there? It's telling us compress, compress, compress with a slight little upward drift. Typically, this ends in boom. Finally, these guys are in there accumulating. We've been able to hold the gains from the earnings announcement. That's good. We're starting to drift higher. No, the market has not exploded higher. I mean, no, the stock has not exploded higher with the market. Very important concept. So let's put the chart up. Pete, the stock doesn't have relative strength. Look, the market's been up, up, up. The stock has just been flat. It has to digest these gains. So the fact that it's been able to hold these gains very, very well and not retrace at all tells me that there's an institution or institutions out there who are buying. And any selling pressure from this initial gap up is being absorbed. And that's why you're seeing nice little higher lows. Medtronic is a device manufacturer. They make stents and whatnot, healthcare company, fairly stable revenue growth. Not a very volatile stock, so you can buy your in-the-money options with a low option implied volatility. Give yourself as much time as you can. Go out 4 months if you can. I'm just going to go out into February so we can look at some options. But the February 70 calls are currently 1075, 1095. Let's call it $11 just to round up so you can get an idea for where they are. You can see that the stock is at 860. So you're buying them pretty close to parity. And the thought process here is that you're not chasing a stock. You're waiting for it to break out, and it's accumulating that type of pressure. And so if it can get up to, let's say, $85, which I think $85 to $90 is a very reasonable range, I think it's going to get right through that major moving average. I don't know if I've got the 200-day up. I've got the majors. So yes, I think it's going to be able to get through that with ease, and I'm looking for it to continue to grind higher. And it doesn't have far to get through that. You can see how it's held the 100-day moving average beautifully. This is not a far distance. So when you get that type of blow off, boom, boom, you're right through it. And now you're starting to get up into here, because this is where everybody gets it on their radar and goes, oh, now that it's broken out through here, I really like it even more. So they're going to feel that move higher, and then you start peeling off the position. I like it. MDT, longer term swing trade. Don't care what the FOMC reaction is today. It's not going to impact what I see for this stock for the next couple of months or so.
Okay, let's see. Any other questions out there? Let me see here. I might have some here. All right. By the way, look at Pan W still going. And you mentioned earlier today in the chat room, I believe, was it EW you mentioned?
Yes.
I like EW here. I like this I like yesterday, it comes right up to the 100 SMA, kisses it, pulls back a little bit, but pretty much closes near the high of the day. And then today opens below it and then just screams higher and with pretty good relative strength here. It's the exact same sector as Medtronic, by the way. So obviously something's happening in the medical device sector today that is, or recently, that is helping these things along.
Yep, and there's the price action yesterday. So this was highlighted in the chat room yesterday. Fast forward to today. Beautiful follow through. Look at the volume. I could take off the 1.0 squeeze indicator to give us a little more room down here, but you can see how the volume has been excellent. Blue line above zero. That means that this stock has a lot of volume relative to what it normally would have. And look what the stock has done. Market down, down, down. And for those of you who are seeing these screens for the first time, I like to tuck the S&P 500 in a screen behind my primary screen when I do these videos. So I'm going to try and keep the 5-minute chart up so that we can see what's happening. You can see the S&P has been drifting lower, lower, lower. What has EW done? A move like that should prompt some profit taking, especially with the market being lower. Whap, 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 whap. We want to own the stock. We are supporting it. These are longer term buyers who are in there. So that's the fuel that you need. And you can also see that by putting up an SPY overlay. So you can see that when you get a market pause in here, the gray line is the market and the stock continues to rally up. That's relative strength. Market pulls back, gray line, stock treads water, holds the high of the day. Relative strength. Gotta love it.
Someone asked, can you please cover your Netflix trade, which you took last week? Yeah, it was a bad trade. Nothing else I can say there. I mean, look, it fell below the EMA. It was relatively weak. It had a lot of room below it before you got to the moving average. It was a good short at the time and actually went into profit shortly after I took the trade. The problem is I should have closed it. And then as news came out on the stock and it pumped it higher, I made a double mistake and should have closed it again. Now, obviously, if FOMC comes out bearish and the stock drops into Friday, yeah, I'll probably, close it with a loss, but not as big of a loss. But that's all I can hope for at this point, which makes it a bad trade because I'm hoping for a binary event. I'm not hoping for any, magical price action technical analysis on it. I'm just hoping that, if anything, that's my hedge. And it's not a great hedge either, because at this point, the delta on it's so fucking low. It's going to take a lot to get that thing back to where I can make a decent return or not a huge loss. So yeah, just I jumped the gun on it. It wasn't so much a bad trade at the time. It was a bad exit in that there was no exit. Let's see here. Can't believe you guys do this for free. Me either. Let's see. Does AVGO have a chance of hitting 1,200 by next week? I have no idea. I mean, obviously it has a chance. Everything has a chance. Apple has a chance of hitting 150 by next week. We don't know. Look, I mean, at some point, there's going to be some selling in AVGO at some point. I mean, stocks don't go up forever. When is that going to happen? I don't know. I mean, it could keep going. The dividend they announced, the earnings they announced, there was some disappointment that the stock isn't splitting, but obviously that disappointment wasn't a lot. So could it go to 1,200? Again, this sounds like someone who's basically asked, should I take profit now or should I ride it? By the way, nothing wrong with taking partial profit. I don't do it, but nothing wrong with doing it.
No, that question, Harry, is should I buy the $1,200 calls on AVGO that expire in 2 weeks? That's what that question is. Yeah. Typically. And that's why I'm always hesitant to give an answer, because, yesterday I had the same question. We're going to make an all-time high by year end. If you had to, somebody had a gun to your head. Yes or no? Yes or no? The thing is right, that you have to see what is unfolding. You're in the moment. It's like I use the Tom Brady analogy all the time. He might know, based on what he's looking at as far as the defense, before the ball is snapped, what he wants to do and where he feels he's going to have opportunity. But he is assessing everything real time after that ball is snapped. Oh my God, the receiver fell down. I got a defensive player in my face. Maybe I need to just take the sack. I mean, those are in the moment decisions. And so if you're in a trade like AVGO, you need to get in at a good price on every trade. I'm a stickler on entry. And then once you're in at a good price, you have to know what you're expecting the stock to do and what you're expecting the market to do. And if all of those things are continuing to perform to expectations, then you continue to hold the position, maybe even add to the position. If they're not happening, then you start to pare back your risk. But you're not mechanical. You're not a robot. You're assessing all the information that's available to you. You're getting the context, and then you're making your decisions. That's what a trader is.
I mean, a trade I like on AVGO? I mean, if you have the margin to handle it, sell the $1,000 puts for $3.60 on December 29th. I mean, am I okay owning that stock at $997 or whatever? Yeah, I would be. If you have the margin to handle that, to me, that's a fairly good trade. But you need to have you're talking about 100 shares of $1,000 stock. So you need to have quite a bit of margin to handle that trade. But still, that's what I would do. Dave Straight today on VRTX. The stock broke compression and SMAs on the D1 on very heavy volume. It continued up this morning. On the M5, the stock compressed while SPY dropped. What were some of the other tells that this was going to break out of the M5 compression just prior to 11:30? I would have generally have trouble taking a trade like this before it confirmed a breakout compression M5, but a few green candles. What else would give a trader confidence in this instance? Well, thanks, Leo. I can't speak for Dave, but I can take a look at the trade. And I can see today we have a huge gap up off of the SMA 50. We have a, and I would not be surprised if Dave didn't take this as a call debit spread, but you have a gigantic gap up. It compresses a little bit off the 5 minute, but then at around 10:45, I mean, what would give me the indication is that this thing gaps up, opens at 373, and on the first bar goes up to 388, And then does it fall below VWAP? Does it pull back? Oh, you have a couple of red, bam, bounces right off VWAP by the fourth bar, heading back up again, will not go below VWAP, and then off it goes to the races. So the fact that this made a gigantic move up and absolutely no indication that it's retracing off of a move like that, that gives me that would give me confidence in a trade like that. I think it's a good trade. And also it broke the all-time high, and stocks that break all-time highs tend to continue going up. Why? Because there's no bag holders up there. There's no one up there at 390 or whatever going, oh shit, I finally get to sell. I've been down on the stock. Nobody who bought that stock today is down. And nobody who bought that stock in the past is currently in the red. That's what an all-time high means. It means nobody is sitting. The only selling you're getting is profit taking. You're not getting people saying, thank God it recovered, I'm out. And that is a lot of selling, right? Where you buy a stock, it drops like 20 bucks and then it goes back up and you're finally even, you get the hell out. This stock has no bag holders. And so a combination of all-time high, doesn't retrace off the gap up, I'm sure are two things that gave him confidence to go long.
I had a question on CRSP, and could you review that long? Some traders took it, including me, FDA approval of their gene therapy drug.
Yeah, I took 30,000 shares.
Okay, so I'll let you address that in general. I don't trade binary events. You know that. I don't like trading earnings announcements, but that's just me. Harry, why don't you take it from there?
Well, my mistake on the stock was forgetting the golden rule of buy the rumor, sell the news, right? By the way, I say golden rule. It doesn't always happen. Many times there's buy the news. But in this case, it was sell the news. I'm holding it because I think it's not a technical thing. I think the stock's going to recover. The price point on this stock is almost double. In fact, it is double. It's 100% up on where it is now. That alone, the moment institutions are confident that this thing has support, and if you look today, by the way, drops all the way down, and now it's actually green on the day. That institutions are confident a stock like this has support, they're going to buy it up, because you have it's very rare that you have a company that's a legitimate company that has good cash flow, good forward-looking guidance, all of that, have the potential for 100% return based on the price point. So, you know, should have I waited? Yeah, obviously I should have, but I'm not worried that it's not going to get back to, you know, the mid 70s. I think it certainly is. So that's sort of a buy and hold for me. But that's not a technical trade there. That is, as Pete said, a binary event, an off the news event, and I'm fine holding it. But others might not have the stomach for drops like that.
Perfect answer, because you knew going in what the news was and what they were expecting, and you're perfectly happy taking that risk. So there's no adjustment required. The one thing that I will note in all of this is that oftentimes you're going to see a lot of software programs out there that do volatility scans. And so it's, oh, this is a great buy right to do, a covered call position, buy the stock and sell these juicy calls. And if they just expire worthless and the stock sits right here, I'm going to make 20% on this trade. And so they do these volatility scans. Well, when you see a big pickup in option implied volatility and the stock is flatlining like this, danger, Will Robinson, danger. The reason that the option implied volatility is higher is because there's news pending. And so if we go into, look at some of these options, I just went into the December option expiration, you see a big spike in option implied volatility. That does not mean go out there and start selling premium. What that tells you is there is an event pending. Danger. You better go in and you better find out what that news is, because market makers are not stupid and they do not arbitrarily start pumping option implied volatility in just because. So there is not a great value to be had out there. If I had a nickel for every time I had somebody that sold, you know, did a buy right or sold naked puts on a stock, and then they call me up when the stock has been halved and they go, well, what should I do now? You never should have done the trade. Awareness. You have to be aware of what's going on.
Yeah, market makers aren't there to give you a good deal. They're there to say, okay, you stand to make a really nice return on this, given the fact that there's a huge range of price movement that could happen in the next few days based on an upcoming event. Well, you're going to have to pay for that. You're going to have to pay through the nose for the opportunity to get that. And you better hope that the range that you're expecting, let's say you're bullish, is higher, or basically what you're counting on is that the market maker was wrong. That they said there's a $5 range here, right? You're paying premium on a potential $5 range for this $100 stock or something. And what you're hoping for, if you're going long, is that it goes outside that range, that it goes $6, $7, because then you'll start making a return, because then the premium you paid is actually worth it, because the stock moved more than the premium would have suggested. But the market makers aren't wrong that often. Now, that doesn't mean they're never, ever wrong, but they're going to be right more than you think. That's why spreads, which are very useful to mitigate the deterrent of premium. If you use spreads properly, you can correct for and take a bullish position, even on a stock like AVGO, for example. You know, you can do the 1080 to 1090 call debit spread. And as long as you're paying less than 50% of the distance between the strikes, here it's a $10 distance, so you want to pay less than $5, you're now mitigating against the advanced premium on it. That's why we advocate a lot for these type of spreads to help you get past that.
I've got a question here from Kristen. When I started out as a pro trader, what could I have done to size less at the beginning? You know, I did trade for a proprietary trading company. I also traded my own capital at the time as well. When you trade for a proprietary trading firm, they pretty much dictate what size you are going to trade. And until you have proven yourself, you're going to be trading next to nothing. And then as you start to prove your abilities, they will increase your size. And then eventually, where it regarded the firm that I traded with, they pretty much took all restrictions off. And in fact, I even asked them to open up their system so that they would let me see a lot more opportunities that were actually there. So they started to lose their edge, which is what happened. And so I'm very knowledgeable about how auto quote works and how the pricing mechanisms work for options trading, because I was trading against those guys for about 5 years or so. And I got to see their inefficiencies, which is pretty cool. And I was trading against those inefficiencies. And eventually they got smarter and smarter. Actually, what happened was they started to price collude, because they didn't care so much about where their models told them an option should be priced. What they cared about was, where is everybody else pricing these options? Because we don't want people picking us off, buying from us and selling and being able to arb that spread. So right now, they're pretty much all just in price collusion as far as I'm concerned. They're all kind of within the same range as far as where the option prices are.
Someone asked here, G Jolly, what are your thoughts on Disney? Seems like a good buy right now. Based on what? I see absolutely nothing on Disney here that indicates it's good for anything, but going on to the next chart.
That was one of my bad picks too. I think I like Disney somewhere in here on this gap up, and then everything looked good and you started to get this nice float higher.
Yep.
Similar to what I showed you in MDT.
Oh yeah, back in
Okay,
November
everybody's
15th. Yeah.
supporting this move, and then blam, it came out. I guess they had a
Yeah.
couple of dog movies.
I mean, today, I mean, back then, I would have gone long back then and let November 15th. I mean, now I don't see anything here other than, I mean, if you really want to stretch it, and this is the let's try to find something rather than it's staring at you right in the face. Is support holding at 90? Yeah, I guess, sure. But I see absolutely no reason to waste time on Disney. It's just you know, and you know, I have a lot of good friends that work at Disney, and they're well aware of how shitty some of their movies are. So,
not that I'm looking for a short, but that's a short I would consider. Got this lower high, you've got this gap fill right in here, and you've got the 100-day moving average coming into play here. So, or excuse me, the 200-day, if it cracked below that, yeah, this is all relative weakness. The market's been up, 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 and the stock just continues to drift lower.
Mm-hmm.
So, yeah, I like that weakness is below a VWAP E. Again, I'm not looking for a short right now, but yeah, it gets below that 200-day moving average. Pete's going to click GTC, and Pete's going to click right on the tail of that, and I'm going to get my alert should that happen.
Dylan asks, what makes you go from I really like this stock right now to entering this trade? A couple of clicks of the mouse generally. You know, I know what you're asking though. You look, I mean, after a while you get a mental checklist, right? And everyone's checklist is a little bit different in terms of everyone might have the same things on the checklist, right? But some people might weight other things more than other traders do. However, you know, there has to be some core foundational things present. The relative strength. If a stock has relative strength and the market is strong at the same time, that is going to give me more of a reason to want to take the trade than if it had relative strength in the stock and the market was weak. Same thing, relative weakness and the market is weak. I'm much more likely to take it. Now, sure, a stock with relative strength when the market is dropping is much more easy to pop and shove. But that's a gravitational pull it's fighting against. And if the market, you know, tanks, the best you can hope for with relative strength stock is that it's just going to consolidate there and give you time to jump out, and it's a buffer for you not to lose money. But those two things combined become sort of, all right, if it has those two things combined, and then on the daily chart, I see, oh, it went through clear levels of resistance. It went through clear, you know, SMAs or a trend line. Now I have those three things going for me. And then I look and, okay, it has above average volume. I mean, if I have those four right there, above average volume, relative strength in the market direction through major resistance, and then finally the fifth one, it confirms by that I mean it went through the resistance and it didn't come back and retest and it kept going with decent volume, or it came back and retested and immediately got bought up and started jumping from there. If I see those five things, that'll take me certainly from I like this stock too. I'm gonna buy this stock. I'm gonna go long on this stock. So those are my five, right? But there are other things, you know, if the sector is strong, if it's whether or not it's a news-based event, is there earnings coming up? What are the option premiums look like, et cetera, et cetera, et cetera. Now, those are kind of all sort of second-tier check marks for me. And the more those are checked off, certainly the more my position size and all that. But for me to enter the trade, those top five probably are key for me to say, all right, I want to take this trade.
It is about check boxes. The more you have marked, the better. And I view it as like a combination lock where all the tumblers have to line up perfectly. And then you get your window of opportunity. And that means that you like what's happening on the SPY D1 chart. You like what's happening on the M5 chart. You got the stock with multiple breakouts, the heavy volume, The D1 chart looks fantastic. You drill down to the M5. Oh my gosh, the M5 looks great and everything is in sync. If it's not, it's okay. It just means it may not quite be time to pull the trigger on it. And that's when you start setting alerts. By the time that alert triggers, so you're looking for a little bit of a dip, you want to get that alert, then you want to evaluate the magnitude of that dip. Okay, now I feel really good because I was looking at AVGO, which I went through that process earlier today. And I like the stock and I like the fact that it's breaking out, but I just don't want to chase this thing when it's making a new high of the day and stacking green candles. I'd like to get at least some chance at a little pullback. So you set your HA reversal alerts, you get this pullback, you get the HA reversal, and VWAP was preserved. Okay, up here, I might not have been ready to enter. I might have been. I could have put on a small starter position here just in case it kept going. But if I felt a little leery about the market or the stock, then the alerts are the way to go. And then when you get that alert, now you've got the additional pieces of information that you need, and you have that confirmation that, yes, had a little pullback and that VWAP held. Now I'm very comfortable getting in here, and I can keep my stop fairly tight on that for a day trade.
And keep the concept of these checkboxes being weighted in your mind. Think of it this way. You're going on a date. It's a first date, right? Person walks in, sitting down, going to have dinner. And the person is stunning. Boom, checkbox, bam, right there. Absolutely gorgeous. Perfect. Okay, they're nice, they're polite, they have money, good family, good everything, right? Everything's working out great. And then they turn and they look at you and go, do you know if you count the number of grains of sand in the world, that's the number of years left for the sun to survive? Okay, date's over. Date's over. That's it. You're an idiot. I'm done. Right? Or they're like, oh, my phone's not working. Mercury must be in retrograde. Fuck off. I'm done. Goodbye. Right? You say stupid shit like that. I don't care how many other check boxes you have. That's going to trump it because you're a moron. And a moron is going to trump everything else, unless you're looking for a one-night stand, in which case, fuck it, right? But you know what I'm saying. That one thing, which might be different from everyone else, depends on how shallow you are, but it might be different. That one thing trumps all the other check boxes. Doesn't matter how many check boxes are checked off. If that one's not checked off, you're not going to a second date. Well, that's the same with trading. If you have everything checked, but it doesn't have relative strength, let's say. It has a volume, it's going up, it's with the market, it's this, it's that, all these things, but it doesn't have relative strength. Well, that's the equivalent of, did you know the moon gives off its own light? No, it fucking doesn't. You're gone. Goodbye. No, you're an idiot. Sorry. Trumps everything else. That to me is did the moon give off its own light comment. It doesn't have relative strength, relative weakness. Don't take the trade. Doesn't matter how many other check marks you get done.
So I guess I'll just carry the dating analogy one step further. When you are day trading, you are dating. You don't care about the long-term stuff per se. When you are swing trading, then you got to make sure you're more in kind of looking for a mate and someone that really checks a lot of longer-term boxes for you. And oftentimes in the chat room, I'll see people post a stock trade, and I got to think to myself, my God, is that the best stock you could find? What about the other 24 stocks that have already been posted? All of those are better than what you've shown me. Why are we even looking at that? And so if you're going through the selection process and you're back and forth and you're iffy on it, I don't know, maybe this, you're probably not on the right stock. Because when you hit the right stock, it's going to be, oh, yeah. Just like when I go through my videos, oftentimes I'll go through a dozen stocks, maybe more. Yes, yes, yes. No, 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 no. And I try and tell you why. So that's what flipping will do for you is if you flip a lot of charts, you'll get very, very good at recognizing those qualities that you like to have in the stock, those check boxes.
All right, let's see what else we got going on here today. You know, I want to check out a short here. Let me see here. How is put putting an alert on Philip Morris, put an alert on JWN, might be a good cheap short, depending. Adobe has earnings tonight. That's not really, it's not a market mover there. The airlines today, slightly weak. I mean, if I look at sectors here, fucking utilities. I hate utilities. Utilities leading the way again. Tech is just flat. Energy is flat. It's pretty, I mean, basically this is institutions saying, yeah, we'll fuck around with a couple of trades, but in general, we're waiting for Powell to say something. You'll get, by the way, a response off of the initial release, but that's going to be your algos. Algos are going to take that release and read it and basically trade off of that. You might get a bump up because there's no rate hikes, whatever. There'll be some commentary in that, but it really is, I would bet by the time Powell comes out to speak, you're going to be pretty close to where we started. All right.
Yes. So initial reaction, you get that at 1 o'clock, you get the knee jerk, you get the long candles, sometimes mixed, sometimes directional, then you get the presser. Usually if you start seeing a move one way or the other after the presser, you'll get that follow through into the close. But we would both caution you not to read too much into that initial reaction, because oftentimes overnight, that's when you're going to get the real reaction. That's when all the institutions have had a chance to digest the news, parse out the entire statement, and decide how they feel the market is going to react to that news.
Someone just asked me, OKTA, OKTA, or CRM? Neither right now. Neither. I don't know why either of them come into question right now. They're both crap trades today. To build up an account that's below 25K, can you show an example of swing trades over one day? Yeah, we've been doing that. Basically, look, a great way to do that is out of the money bullish put spreads. Those are, particularly if the market is strong as it is right now, an out of the money bullish put spread is an excellent way to make passive income and build up an account. I mean, if you took, for example, you could even go to, let me find a good stock for an out of the money bullish put spread here. You know, Microsoft actually might be a decent one, because you have a pretty good line of support here at 366, then 353. Let's see if I could find anything decent on Microsoft going into maybe January 5th, and then looking at, I mean, if you can get the 360, well, I'm looking, trying to get, maybe go to the January 12th, Microsoft, 355, 350, 360, 355. The 360, 355 maybe brings you right down to the SMA 50. I'd rather do the 355, 350, which got a little bit further than I tend to like. But the 355, 350, if you can get that for $1 on January 19th, that would be probably a decent push put spread. I like how Microsoft just kind of hanging in that area. NVIDIA also another good one for a bullish put spread. It's a little bit more volatile, so you just have to have a stronger stomach for it. But that's one way of building passive income. You just got to be patient with it.
Yep. So I'll just give a few cents worth on Microsoft and bullish put spreads. As you can see, this previous resistance here, which is now support, happens to come into play with the AVWAP-E. So you've got a couple of lines of support here. You can see how you've got these tails for Microsoft here around the 366 level. The point is that you've got multiple levels of support that are above your short strike price. So those have to be cracked before your put spread gets into trouble. And that's why we want to distance ourselves from the action and go below those support levels. That's where our short strike price is. And yes, we're looking for, if you take what the maximum risk on the spread is, you want to be generating a 25% return based on that maximum risk. And probability is the key to those. You know, a lot of times we get questions, why would I ever want to put on a trade where my max possible profit is $1, but my max possible loss is $4? Well, if the odds are 50-50, you would never do that trade. You would lose a lot of money. But if your probability is closer to 90%, then you get a positive expected value on that, and you're going to want to do that trade. And it's a low maintenance position. For a lot of you who have jobs during the day and you can't watch the market, you're so far from the action that you don't really have to do anything. You just check the position 5 minutes before the close each day. And if the stock's doing what it's supposed to do, tick, 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 time premium decay is eating away at the position. And you don't have to worry about it. So
yeah,
that's my take on bullish put spreads.
The stats professor in me comes out, and everyone needs to understand the concept of probabilities. If you're risking $4 and you're going to win $1, right? Now, let's say 9 out of 10 times you win. So you win $9, and the one time you don't win, you lose $4. Out of 10 tries, you're overall up how much? $5, right? You've lost $4 when you lost that one time, and you made $9. So overall, you're up 5, and that's what a 90% win rate. So let's say you're risking 1, you're risking 4, and you're making 1. If you have a 90% win rate, you are coming out ahead on that trade by quite a bit. The concept of, in a bullish market, what is the likelihood of a bullish stock breaking through 2 major lines of support and finishing below your short strike by the designated date is going to be, as we've shown in the past, more than 80% of the time, you are going to, that trade's going to be profitable. That trade is not going to break below your short strike. So if you get the setup correctly and the market correct, you're fine. There's even a possibility, if it does break the short strike, of still managing the trade in a way where you can get out and break even. So that adds to your percentage points. So it really is a percentage game. You could risk $10 to every one you make if your likelihood of making money is higher than 95%. It really just depends on your probabilities. And how do you get to know what probabilities are? Well, that's why in the past we have done well over, 500 whatever bullish put spreads, and know, okay, this is the win rate, which was like 92%, 93%. This is the win rate if we stick to those setups. So with a 92, 93% win rate, risking 4 to make 1, getting a 25% ROI, A, you're beating the market with a 25% return on your investment. And B, as long as you hit that win rate, which, that's where win rate matters. That's where the statistics matter in those cases. So that's kind of how you need to think about something like a bullish put spread.
I have a question in 5 words or less. Can I share my thoughts on getting over the mental side of not letting winners run and cutting too quickly? Yes. 2 words. Game plan. What is your game plan? And I'm not talking about some haphazard shot in the dark I got a gut feeling about this one. I'm talking about really putting together a game plan for each trade, and it starts with the market D1, goes to the market M5. What could possibly happen? What's the scenario analysis for the day? There's a gap up. Is there a chance for a gap reversal? What is the likelihood of it? Same thing goes through all the way down to the individual stock. And as long as everything is happening in accordance with the game plan, then you let your trades run. And you may get into a day trade. We'll say day trading is where we'll focus since it's short term, and we can look at instances there. You may get into a day trading situation like this where you get a gap down. Hey, we know that gap downs are good in a bullish market because we can expect a gap reversal. Don't know how much more the market has left in it. We're going into the FOMC soon. So yeah, I'm going to get long in here. Oh, we got to break out to a new high of the day. I can add to my bullish positions. This is looking pretty good, but you still don't know if the market's going to roll over in here. Lo and behold, you start seeing higher lows. Well, now you know you have a bullish trend day. So you start letting your winners run. You're watching the price action. You're aware of what's happening to the market. You're aware of what's happening to the stock, and you are adapting. You're not coming in and saying, I'm going to buy it here and I'm going to sell it right here, because I've found that this is the magical target price that needs to be respected, and that's going to be optimal to profit taking right there. How are you going to know? You don't know. You don't know what the market is going to do or the stock. So you keep riding it as long as you can. And then as that picture becomes clear, you roll with it. Game plan.
By the way, someone asked, what's the downside of the out of the money bullish put spread strategy? Seems too good to be true. The downside is that people tend to fuck them up. That's the downside. I mean, just straight up. People tend to think, oh, I'll take less than 20% or 20 cents per dollar in the spread credit, or people will fold them too quickly. They'll take only partial profit. And when you do that, you mess up your percentages. You just, you know, if you start taking profit at 50% profit, well, now run the likelihood of coming out ahead when you're taking only 50% profit. You need to be right like 95% of the time. So that's the downside. Like any complex spread with a very particular setup, people can screw them up. And someone asked,
I'm sorry, I just want to interject on that because a very important point. Stock selection, very important. When the bottom is falling out of a stock and it is just absolutely tanking, it is not the time to go selling it out of the money bullish put spread. The other time you don't want to do it is when you have a market that's selling off like this. So identifying these inflection points is very important. Now this, I don't care how good your bullish put spread was, pretty much from August through October, you're going to be losing money on that strategy because the market was trending down. Well, same thing in 2022, we had a bear market. That is not a time when you want to be doing that strategy. But now on a weekly chart, you can see, yeah, okay, so we had that weakness, we're through it. Now we're starting to get back into a much more bullish market environment, and we don't have to worry about the rug getting pulled out from underneath us. Now we can start looking at that really long-term market trend. And this is why bullish put spreads most of the time are going to be a fantastic strategy. Look at that 40-year market chart, and you'll see it goes pretty much straight up. So just wanted to make sure that I interjected that because market first.
Yep. Couple of questions. As much as I think Pfizer is the most corrupt company, it's at a multi-year trend line support in the weekly chart. It's just one you would consider going long. All right, I have 2 points there. I mean, a little bit of rant here, but one, don't stop with the most corrupt company. Stop. You have a higher standard of proof than shit that you might read on the internet and go, oh, there's corruption here. Yeah, I'm sure there's still corruption everywhere. Do you know how strict the regulatory laws are in America for a pharmaceutical company? Yeah, am I saying they're not corrupt? They're all fucking corrupt. But outside of this country, they're probably 10 times more corrupt. To get even a aspirin approved in this country, they have to jump through 50 more hoops than anywhere else in the entire world. You have no idea the level of regulation and how highly regulated these are. That everyone thinks these kickbacks and there. Trust me, it doesn't happen the way you think it happens. And well, how do I know that? Because I know some of these people. I know what they make. I know what they do. It doesn't work the way you think it works. So one, get that out of your head. Have a higher standard of proof for things. Two, stop bottom feeding. No, you don't go long on Pfizer here. Look at it. It's a shit stock at the moment. It is falling apart because of the lack of vaccine adoption, and that is a larger part of their revenue profile than other products are. So whether or not, does it have much further to fall? Probably not. Is it at support? Probably is. Would I go long on it right now? Absolutely not. There's no fucking reason to touch that stock. There are plenty of other stocks that are much better at going long. And also, Ning says, how do you know if the market is just digesting its gains or profit taking is just occurring after a big move versus the possibility of a potential trend reversal coming? Well, one great thing to use is Heikin-Ashi candles, right? Use those on the daily chart, and you can see a trend reversal on Heikin-Ashi candles. Chances are, if you get a trend reversal and that trend reversal continues, so you have what you can even search for on Option Stalker, which is a HA plus, where you can see that reversal is continued. Now you're looking probably not so much a profit taking, but a reversal of a trend. So HA candles are devised in a way that will help you try to discern the difference between simple pullback, reversion to the mean, coming down to the EMA, or a trend reversal.
Yeah, and one quick note on that is that the depth and duration of the drop help us determine how significant it is. So if you get a very brief dip, like you've got this move here, and now you get your little drop, well, how far did the market move during this bullish run right in here? How far did the market retrace during this little bearish drop? Well, most of those gains were preserved, better than 3/4 of them. This dip here is very brief and shallow relative to how much time the market spent moving higher. That tells us that this is going to be a good entry point to get back on that longer term trend. On the other hand, this is a substantial retracement from this high. Okay, we've given back all the gains from that last leg of the rally. I need to respect this. And this is when you start looking for that lower high double top. Now we start getting a triple top in here. Okay, this is probably going to be a pretty decent decline.
There you go. Any other questions you got there, Pete?
Let's see. JD was a stock that I highlighted in the chat room today. Did the longer term support not bother me on this short, which was a horizontal support level? And I qualified that in the chat room, and I said I'm not really looking for a short. So that horizontal support comes in at 24.03. Lots of room for that stock to drop down to 24.03 for a day trade, which is all I was looking for. And yes, JD has actually been a pretty decent little short, continuing to drift lower and still has plenty of room, 68 cents down to $24 for a day trade. That's plenty for me on a $24 stock to consider. So no, I mean, I saw it on the chart, but it did not weigh on whether or not I felt that this is a good day trade.
Let's see here. There's not really any great continuity on shorts today in terms of a sector or industry popping that's really presenting me with really good shorts. Also, because of the run up that we've had in the market, shorts that a lot of the shorts you might be looking at are going to have decent daily charts. I mean, look at, UNP today. Sure, that might be a decent short today, but you're running up against a pretty bullish daily chart, and that makes it difficult to swing them. And so that's also another consideration, which is if the short goes against you, can you swing it? And only stocks that have very bearish daily charts really kind of allow you to swing short positions, but you're not going to find many of those given the recent uptick in the market.
So JWN would be a good day trading short. Again, I'm not doing anything ahead of the FOMC for crying out loud, but if I come into the trading day and I look at the D1 chart on JWN, so let's put that up. And so there's your 5-minute chart. Yeah, this thing has continued to sell off even when the market was higher today. What was the stock doing? Drip, drip, drip. Ooh, there's your VWAP. Can't get above VWAP. Okay, what's the D1 look like, by the way? Okay, volume. Okay, checkbox, checkbox, checkbox. What about the D1? Ooh, well, that was a pretty severe rejection from that 200-day moving average yesterday. We closed below it. Gap up, closed below the 200-day. Today we opened below it. Drip, drip, drip. Well, obviously now we're below the 100-day, but yeah, with that type of momentum, I'm expecting that previous resistance is now support to be tested and violated, and there goes the 100-day moving average as well. Yeah, that's the kind of stock I would look at.
I'm looking at EOG maybe, but it's kind of sitting on pretty strong support here, so I wouldn't touch that one. Verizon, Verizon, decent, but again, it's not really a huge mover. Well, I'm looking at some of these stocks like Zim and Edit. I remember when these stocks were like $60, $70, $100. These things are, a lot of the buy and hold philosophy on some of these are just not panning out.
You can see how the market has been drifting. Market's been drifting lower, by the way, since we pretty much started. So we had this little push higher, and then now tiny compressed candles. The volume's very light. We're in wait and see mode. Only 20 minutes or so out.
Yeah, I'm long MDB, by the way, still. I like MDB. It got accepted to the NASDAQ 100, which means that when that clicks in, there's going to be a lot of buying on that ETF. I think it held pretty well. It snapped back after earnings and closing up. So I still like that position. I'm still holding that position there. NVIDIA is always NVIDIA. What's that?
I'm looking at MDB, very choppy stock. I mean, it's more so than normal. Look at this thing all over the board. So the point there is that if you take a position in MDB, you do not expect off to the races. You expect that you're going to have this.
Yeah. You really have, and that goes back to the game plan idea. I mean, you really have to know what can you tolerate. And if you can't tolerate choppiness, or if your thesis, then you're not looking to certainly, if you're looking at a stuff, think of it this way. If you make a trade and you have to ask yourself, one of the first questions is, am I okay swinging this? First question. Second, if it goes against me, am I okay swinging it? Third, how much does it have to go against me before I'm not okay swinging it? And then you have to look at the charts and see, well, this stock has potential to go all the way down, like, $10, whatever, before it hits a support level that it could bounce off of. Are you okay holding it then? And if the answer to all that is no, there are plenty of other trades out there to take where if you don't want the roller coaster, your thesis has to be pretty strong on it to withstand the roller coaster. But, Then again, you have short-term ones like Tesla that I did today, where, okay, I'm willing to withstand this until I see a break of VWAP that is confirmed. If I get that, I'm out, take the $1, $2 loss. If not, I'm going to wait for that drop on the SMA. Either way, I'm out before the FOMC, a different type of game plan. So every stock has different game plans going in. You just have to know what your thought process is. And then it's a question of sticking to it, right? Then it's a matter of, okay, I'm okay taking this loss. And that's where I came up with, the idea of the swap method, because a lot of people are just hate taking that loss. Just swap it out for a better trade. Take that money and put it to work in a different place that will give you a better chance of a return. Headline off Meta here. Circulation of a tweet by Meta Quest. It's time the Xbox cloud gaming app is finally here with massive catalogs of high quality games. You can play anywhere you want on a massive screen. Xbox not required. Interesting. I don't know exactly why that's popping by Meta. Oh, when they pop their own stock like that.
There's a little pop. And right now, the other thing that I'll mention is oftentimes when you get into a very dull market that's waiting for news, it could even be during the summer doldrums. There's nothing happening. There's nothing happening. There's nothing happening. And then out of nowhere, you get some kind of news release that sparks a 10 or a 15 point S&P rally or a big pop in the stock. It's just the market makers, in my opinion, trying to move the stock. Sometimes that news is even recycled. Sometimes it's rumors. So when things really quiet down, don't bite on bars like this. Validate everything. Know that they're just looking for something, anything to generate some excitement.
Question here from Table 27. Ulta seems like it's near the top based on resistance trend line dating back to August 2021. Do you think puts here are good for a gap fill? Again, you're failing the ABGO test. You're looking at a bullish chart and you're saying I should short it. That doesn't work. I mean, I don't know how many times I can say it. That doesn't work. Counter trend trading doesn't work. If it worked, retail traders would be rich, but they're not. They're broke. I guarantee you 90% of our audience has not made money trading. And if it was as simple as I'm going to short when it hits the top and I'm going to go long when it hits the bottom, and I'm going to tell you where I think that top is and where that bottom is, 80-90% of you would be making money. But you're not making money because what you're doing is you're betting against the institutions. The institutions don't think they should be shorting that stock right now, but for some reason you do. Well, who do you think makes more money? They make money. Who do you think they take money from? From you. Why? Because you're up there shorting something at the top. Don't do that. Don't counter trend trade. It is the number one, beyond a doubt. No other thing comes close. The number one reason why retail traders lose money. You all think you know more than institutions and you counter trend trade, and it doesn't work. I don't know how many times you can look at your damn account and see it losing money before you finally say it doesn't work. But know what? You don't say that because you lose the money. You go, I'm not trading anymore. The whole system's rigged. Fuck it. They're all against me. It's all a big cabal up there. No, it's not. It's just you. You are the problem. You're the one shorting at the top. Stop thinking you know where the top is. You don't know where the top is. They do. You don't. Stop shorting. No more counter trend trading. Jesus H. Christ. Sorry, Pete, go ahead.
Yeah, I have a similar question. It's like, well, you guys always seem to be buying after a big move has already happened. How about showing me something that hasn't moved yet? And it has to do with that same mentality that, oh, well, I'm not going to buy here. It's already run up so much. And it's good to be prudent. It's good to be patient. But those moves higher tell us that the institutions are in there. And oftentimes that kind of notion that, well, this is just a hair salon and people are going to have to cut back because of the upcoming recession and they're not going to get their hair done anymore. So it's hit resistance here before. So I'm going to short it right here and I'll be early. That is such flawed thinking. And if anything, this bid is growing and it's going to get through this high plus trend line and stage another leg higher. So how do we know when we should short? How do we know when there has been resistance? You have to wait for technical verification of it. So here you get this blow off rally in ULTA and you get this pullback. I'm going to short it right here. I knew this was coming. This is it. Well, no, it's too early because you're going to get on a big rally like we had here. Just like I told you earlier, you will get that retest. Now I have a lower high double top and I have a very long-term trend line that comes up through here. I have a long red candle through it. Now I'm starting to breach AVWAP-E. Okay. Now if you want to short in here, you can, but not here. And you have to wait for that technical break. You have to wait for that confirmation. But everybody thinks that, oh no, if I short right here, I'm going to be the big winner because look at all that profit I had. And you look from here to here. You don't think about, oh, gee, there was a big bounce. Well, everybody would have gotten shaken the hell out of that move. You would not have held through that bounce, which retraced about half of that move. You'd have been like, yeah, this thing's going to hell in a handbasket. Here you're like, shit, I'm an idiot. God dang it. I should have taken profits down there. So you take your gains on the short up here. That's a nice little short right in there. Oh, yeah. So anyway, yeah, you don't want to be out there calling tops or calling bottoms. You don't want to be down here saying this is a great scoop. Oh my God, this stock is so cheap. Could still continue to go much, much lower. Got to wait for that confirmation.
A second here.
While you're waiting, they had a question. Harry, how much longer do you plan on doing this? And I'm not just talking about today. I've got a question. Pete, you and Harry are, you're putting out great information. How much longer do you plan on running the chat room and doing these live events?
I mean, I don't know. Probably directly proportional to the number of trolls out there, which really just drain the life out of you. I know there's a way to get this message to break through, and I know there's a way to do it, and I know this is a good career, a window to financial opportunity that a lot of people need, can use, and there's no reason why they can't do it. It's just, for me, it's really continuing to try to refine the message in a way that it does break through. And I don't think it's there yet. So I'm going to keep trying until I know it gets there.
Well, for me personally, I've been doing it for a lot of years, since 2006. So I'm getting pretty old and my skin is getting thinner than it has been in the past. I used to be able to deflect a lot of criticism, and now I just hate putting so much time and effort in and then having the trolls, the 5% of the people come in and just destroy you. It's like, what am I even doing all this for? And you get a lot of the same questions. The thing that I think all of you should know about both of us is that this is our passion. We love doing it. We love sharing our passion with other people. I think, I know I'm going to continue to do it as long as I have fun doing it. If it becomes a burden, I'll do less of it. What you can learn from me as much as you can, as fast as you can. And I still plan on doing this for 2 or 3 years, but who knows? I mean, I'm getting pretty old, and one bad health event, who knows what that might have in store for me.
We have 11 minutes to the FOMC comes out and says they're not raising rates. Not, and then we get Powell. And what do you think, Pete? I mean, we can think about coming back afterwards, or I mean, I think everyone should just kind of watch the price action here and don't jump on the move. Wait, listen to Powell, watch the price action with Powell, see what they're reacting to. And, you know, they're going to be looking for confirmation on those rate cuts. If you see Powell start talking about, you know, holding steady for longer, non-entertaining rate cuts, things like that, and the market is dropping off that news, you know, again, probably best to just pay attention to what is dropping proportionally more or staying strong if the market drops, and holding tight until tomorrow. You don't really want to make a move off of this reaction today. But, you know, I think it's just a matter of watching the price action.
Yeah, I'd agree with that. I mean, we've been at this for a couple of hours. We've answered a lot of questions. And so it'll be good to take at least a little bit of a break before the action heats up. And then we'll be back in the chat room trying to figure out where the market's going to go next. So yes, watch that move. Again, my personal opinion is that if we get any kind of pullback in here, we'll probably check that breakout. I don't think the pullback will last more than a few days. And I think asset managers are going to be back in there buying. And longer term swing trades, probably an opportunity to get long in there. On a pullback that's brief and shallow, I will be doing a video Sunday, so I'll be able to do follow-up on what we saw Thursday and Friday. Harry and I plan on doing these on Wednesdays, and I think this kind of 2.5 hours into trading works pretty good, wouldn't you say?
Yeah, I like it. I think it works great. So we'll definitely do one next week, and let's see how the FOMC goes. And until then, all of you, keep your powder dry, be in cash if you can, watch this move, and just set alerts. Set a lot of alerts and wait to see what happens.
All right. Trade well, everyone. Thanks for joining us.
Great. Bye-bye.